Hi, I'm James Varaklis from IBEX Wealth Advisors, and I'd like to welcome you to our mid-year market update.
Here we are, early July 2022, about to start the second half of what has been a most difficult and unsettling year so far. The COVID-19 pandemic has perpetuated so much disruption, including the global supply chain. Too many dollars chasing too few goods has spurred inflation not seen in 40 years. This has caused the price of almost everything to surge, most notably food and energy, something that you and I see at the grocery store and the gas pumps every single day. The average price of a gallon of gas here in the United States topped $5 for the first time ever. Financial markets responded in dramatic fashion. One of the broadest stock market indices, the S&P 500, entered what's known as a bear market in May, which means it had fallen a stunning 20% from a recent high in January, joining the technology-heavy NASDAQ, which had fallen into a bear market in March. One very important market that does not get a lot of attention is the US bond market. The US bond market is actually twice the size of the stock market as measured by market capitalization. So as big as the stock market may be, the bond market is twice the size, which makes it a massive market. The widely followed Bloomberg US Aggregate Bond Index, a good proxy for the overall high-grade bond market, suffered a total return decline of about 10% year to date, while long-term Treasury bonds have lost nearly 20% in value in just a few short months. These returns are the worst in 4 decades and are really fueled by investor anxiety that the Fed's plan to fight inflation by raising interest rates would hurt bond prices.
So, how did we get here?
During the pandemic, the federal government tried to stimulate economic growth by pumping more than $6.5 trillion in federal fiscal stimulus into the economy and by lowering interest rates. As a result, the American public went on a spending spree. Factories around the world that had shut down due to pandemic closures were slow to respond, causing supply disruption. This sparked higher prices.
Imagine walking into an Apple store that had only one iPhone for sale, with a line of customers out the door. Bidding wars would push the price of the iPhone well beyond what it normally sells for, otherwise known as inflation. But was this enough to perpetuate such a high rate of inflation?
The Russian invasion of Ukraine was the unforeseen catalyst to much higher inflation. Russia and Ukraine account for roughly 1/4 of global wheat exports and contribute over 1/3 of natural gas and oil to Europe. While the human toll is tragic, unquantifiable, and unforgettable, sanctions imposed by the West on Russian exports caused oil prices to spike over 65% almost overnight, contributing to higher food prices and fuel that exceeded $5 per gallon here in the US.
So how do governments around the world curb inflation?
The Federal Reserve seeks to control inflation by influencing interest rates. When inflation is too high, the Federal Reserve typically raises interest rates to slow the economy and bring inflation down.
Said another way, when a fire begins to rage, enough water must be used to extinguish it.
To date, the Fed has increased its benchmark rate by 50 basis points in May, 75 basis points in June, and is widely expected to increase by an additional 75 basis points at the July meeting.
While risks remain for the US economy as the Fed attempts to achieve what's known as a soft landing, and that's the delicate balance of raising interest rates enough to slow inflation, but to not sink the economy. It's important to not lose sight of the opportunities that present during these market dislocations. US equity valuations are in line with their 25-year average, and we are investing an inordinate amount of time researching companies that continue to declare excellent earnings, strong revenue growth, and a confident future. By narrowing our focus to companies that supply the consumer with what they need versus what they want, so the needs, for example, would be food, internet, phones, technology, healthcare, energy. We believe these sectors will be best positioned in this current environment and will offer the quickest recovery in their share prices. And while rising rates can temporarily dislocate fixed income markets, the bond market, it's important to recall that higher rates today mean higher income for bond investors for the future. And much like the stock market, there are opportunities in bonds for those seeking income, tax-free income, principal protection, and diversification for the rest of 2022 and beyond. There's no question that this is a tough environment for investing, but we ask you to remember this. Every storm cloud eventually runs out of rain. We have every confidence that the markets will return to a more normal environment and eventually climb higher as they have in the past. But between now and then, patience and perseverance will be the key ingredients to successful, longer-term investment performance. We express nothing but gratitude for the opportunity to work together, and we encourage you to reach out to us with any thoughts, questions, or concerns that you may have.
Enjoy the rest of your summer, and we look forward to seeing you a little bit later this year.